Right. Thanks for tuning in to the Mutual Fund Show. Now, today is probably the right day to do it, and the markets helped us in terms of getting you the show to prepare you for what's been the nature of the market today, and that is volatility. Anybody who saw the markets today or who's seen the markets over the last 14 or 15 days, I would guess maybe it's also natural to get a bit unnerved. You would think, what if the markets were to correct further and what would happen to returns? Because people tend to look at the short term. People tend to worry about the short term a lot more than preparing for the long term. And I think if there's one central message that the Mutual Fund Show has tried to give to every investor who's investing either in mutual funds or otherwise, is to not think about the short term, but invest for the long term. And if you've done that, then just the recent volatility shouldn't bother you. But I think before deciding upon what should be the topic of today's discussion be, I was having a chat with Kalpen Parekh, our guest on the show, and he thought that it was apt to bring out not that people shouldn't expect volatility, but how should people prepare for this volatility. And Kalpen, thanks for joining in. Thanks for suggesting that topic as well, because I think it's very pertinent, especially what's happened in the last couple of weeks. Now, I would guess there are two ways to do this, right? One is how people prepare for it by maybe keeping funds at bay, maybe investing more when the chips are down, and two, trying to prepare their minds to deal with the volatility in a better fashion. Maybe that is actually a tougher battle.
Actually, in fact, wise men of investing say that it's not your IQ alone which determines how rich will you become, it's your EQ and the temperament. So end of the day, investing and wealth creation is all about time and discipline and being able to ignore intermittent noises and reflect that investing is nothing but a replica of nature. You have ups and downs, you have periods of good returns and periods of bad returns. But as long as we recognize that over long periods of time, equity as an asset class only goes up, and that long period of time has to be reasonably long, means 7 years, 10 years, 15 years. And there's all data and evidence which highlights that. Investors should also recognize that every 2 or 3 years markets fall. It's the part of markets to go up and down. In fact, if you take daily returns, 48% of times markets close lower, and 52% of times they close higher. So the odds are even if you notice it on a short period like a day. But as you expand your time horizons to few years and to decades, the odds of getting positive returns goes as high as 100%. And there's enough evidence of markets globally and in India, and more so when you invest through mutual funds, because mutual funds to some extent also cushion that volatility. If your time horizons are 7 to 10 years, at large, investors have made meaningfully higher returns than traditional investment asset classes.
Yeah, actually we put out that data as well in one of the other shows as well. But Kalpen, I think the important to bring out the points that we were trying to make, that it is okay if we can't predict volatility, but it's not okay to prepare for volatility. So one is the mental aspect, and I think you spoke about it, and we'll talk about that as well in detail. How can a person prepare himself or herself for the non-mental part? I mean, what do you see the more successful mutual fund investors do? Do they up the quantum of investing into funds when markets crack? Are there levels or are there percentage falls wherein such investors tend to do more investing? I mean, is there a set pattern out here?
So I think you're asking for a mathematical framework,
yeah, if there is
formula. One. So very intuitively over long periods of time, the formula says that markets mean revert from a certain zone of valuation and a certain zone of returns. So when valuations are close to 10, 11, 12, that's a great time to sell everything and invest in equity. And when markets hit a high of 30 times valuation, it becomes a bit challenging to earn future returns. Now, as investors, it's very difficult to try and time these things because we as investors may not be only doing investing, right? We have our other jobs and other professions, which demands more time and attention because that's where core of our earnings is going to come. So when it comes to investing, I think products like asset allocation funds and balance funds give you an automatic hedge because they rebalance between equity and debt as an asset class, and they rebalance around these valuation points depending on where interest rates are and where valuations are. So one way to prepare for volatility is one, to acknowledge that there will be volatility and not deny it, number one. Number two, use products depending on your appetite for fluctuations in your portfolio. So There are many investors who say that if my money is for 10 years, I don't worry what's going to happen for the next 2 years. Though there are not many, there are very few like that. Most of us get unnerved. It's very natural to do that. Our wiring since evolution of mankind is always, fear or flight. So when there is fear, we flight. So it's hard coded. So by design, our natural survival has happened because we react like this. But that instinct does not work in investing. In investing, the instinct has to be opposite.
Right.
When there is fear, be bold and invest more, and have that temperament. So a mathematical model would be, either you study yourself, which I think is not very practical, because there are expert models designed through funds which allow you to do that. And today, like I've said in the past on this show, mutual funds have some very interesting, asset allocation products. There are static asset allocation products which have a ratio of 65-35 between debt and equity. There are dynamic asset allocation products which change the ratio of debt and equity depending on which asset class is more attractive. So for example, if fixed income yields are at 8.5% today, they are reasonably attractive than what they were 1 year back when bond yields were at 6.5 or 7. So fixed income has become more attractive, whereas equity prices have gone up without earnings going up as much, while there is hope that earnings will recover, and over time that will, but it's taking its own time. So relative attractiveness of fixed income has also moved up. So any product which plays between these two asset classes very actively can be a preparation of volatility. So investors need to also look at these type of products in their bouquet and plan accordingly.
So what are these funds? But just wondering if DSP BlackRock as a house has some funds like these in their stable.
So many funds have it, including DSP BlackRock. We have a fund called Dynamic Asset Allocation Fund, which asks one question every day or every month, that between debt and equity, which asset class is more attractive, and give more allocation to the asset class which is more attractive. So for example, our Dynamic Asset Allocation Fund would currently have more than half the portfolio in fixed income, and the rest of it is in equity. So it has calibrated its exposure, because in recent times, equity markets have been running up and bond prices have been running down because interest rates have risen. So you calibrate and increase your exposure to fixed income for this part of the cycle. At some point, if this equity volatility and correction continues, equity becomes more attractive. So we take money out of fixed income and put it here. Now this product, over the next few years, if an investor were to look at and invest, is far more tax efficient. So instead of the investor moving between these two asset classes and mistiming, a vehicle like this can actually give tax efficient, lower volatility returns to an investor.
Okay, so choose your products carefully, and there might be options available in order to deal with short-term volatility. One question though is that if somebody, as you said, invests with a 10-year horizon in mind, and the attempt would be to get more and more people to do that, invest for the long term, plan for the long term if you're investing short sums, then and the reason I'm asking this too is because I've had a number of advisors come in and say that if you're actually investing for such a long period of time, then don't bother with types of funds, just go in for equity mutual funds because they'll give the best returns. Would you concur with that?
I think so, and let's look at evidence rather than just going by a view. Look at evidence. Which was the worst point to invest in the last 10 years? Was when the market was at its highest from a valuation point of view, which was, I think, 8th or 9th Jan 2008. 8th Jan 2008. So take Sensex was around 21,000. At 21,000 today has gone to 36,000. The CAGR compounding of the market would be around 7%. Now, fixed income also in the same period would have given you 7%. But had you done an equity fund which has some element of alpha, would have done around 10 to 12% CAGR. So an investor who ignored all the ups and downs in between and had the temperament to not look at it and not act, has earned higher than what fixed income would have given. But more important, and I think I'm glad that in the last 2 years a lot of money has come through SIPs. It means volatility actually is a friend for an SIP investor, because if markets fall, you're buying more and more units. Like anything else in life, we want to buy, we want prices to fall, we celebrate corrections. In equity, we don't celebrate corrections, we worry. An SIP investor should actually, expect that markets stay volatile, so you can accumulate in your accumulation phase. And I think Indian investors have just begun their accumulation phase. This industry has taken off in the last 2-3 years. SIPs have just completed a life of 2 or 3 years of, on half the base of investors.
Sure, meaningful life.
And it's still yet to come. So in the same 10-year period, if I would tell you when markets have given only 7, and funds would have given around 10% return. SIPs would have done 13 to 14% CAGR because you benefited from this volatility. So the investors doing SIP should least worry about volatility, should actually be happy that my next unit is going to come at a cheaper price if the markets were to correct.
Got it. Now, remember, I think a lot of viewers would have heard this, people say this, that trend is your friend and volatility is your enemy. But that would probably be true for a pure play equity investor. Again, somebody who's not having a long period in time. I think Kalpen makes a very important point. If you are indeed an SIP investor, for that matter, even if you're a mutual fund investor, maybe volatility could be a friend because it lets you buy what will be a much higher NAV asset at a lower NAV, and you should be celebrating that fact. But while we are talking about this, it's very important to bring out the point, Kalpen, that it is not that you will always get returns. There will be period of no returns, low returns, or negative returns.
Yes.
And investors should be prepared for that, not get spooked by looking at the NAV and seeing that it is much lower than what your existing NAV was or a previous NAV was.
Absolutely. And again, one thumb rule is don't break the journey of compounding by looking at it again and again. So the biggest enemy of our returns at times is we ourselves and our own behavior. So we are all fans of cricket, right? Indians love cricket, and we've seen that many times we win the series. We may lose one or two matches in between. No player scores, the best player, whether it's Virat Kohli or Dhoni, doesn't score a century in every match. Though we expect them to because we like it. But that's not how reality is. Likewise, in equity, it can't score a 6 every year. So, again, we look at 38 years of data of Sensex. In 38 calendar years, 7 years, Sensex gave negative returns. But if you ignored them and stayed put, you've seen markets giving you, roughly 360 times from when they started in 79. So 7 out of 38 is a great probability in our favor because 31 out of 38, you've made money. Likewise, when you look at mutual funds, I would just urge investors to always, look at what has been the worst return if my time horizon is 5 years. So if I know my money is for 5 years, let me ask this question: what was the worst return if I had invested for 5 years? And if that unnerves you, then you ask the next question that, okay, is this right for me or not right for me? And if you are an equity investor, the time horizon has to be 7 to 10 years, which is what we've been saying this in all our interactions. A business does not become relevant in 3 or 4 years. A business needs a full cycle. We as individuals in our careers progress over 10, 20, 30 years. Our needs are over long periods of time. And I repeat again, half of mutual fund industry is fixed income. So if you have short-term needs, use debt funds. But for your long-term wealth creation to beat inflation, put that part of the money with a longer-term horizon, then you don't have to worry about volatility. People might stop watching you and me, but that's okay. Fine. We want people to make money end of the day.
Yeah, I quite like the example about Noah's Ark, Kalpen.
Yeah, so I think they say, those who've read Bible, they say that, you don't build the ark after the floods have come. You prepare for it early. So I think as investors, if we know that there will be periods of volatility, you just have to calibrate either your expectations and temperament, or you choose your product design accordingly. And like I said, in a very simple way, mutual funds have these hybrid funds, asset allocation funds or balance funds, which help you cushion this volatility and navigate through it.
Okay. Finally, it's a very interesting point that you're bringing out, a checklist to help you decide if a market commentator is going to help you make good decisions. Now, I'm throwing this off at Kalpen. I'm not a market commentator. I'm merely an anchor who asks questions. But let's talk about a market commentator who helps you make good decisions. And some 3 points. Would you want to elaborate on this? Because the first point is, have they created a story about why asset classes have changed? And I believe the cross indicates that that person is not a good market commentator.
So this is not an authentic thought from me.
Sure,
it's something I have read, and I relate to it. I always feel that there's a lot of mathematics which works in investing and behavior which works in investing. We invest around emotional stories, which is not right. Rational investing means keep emotions at bay. So I've always urged investors, don't worry about the India story. What will finance minister do, prime minister do? They are doing their job. We have to do our job, which is invest more when markets are low and invest for long periods of time. So many times, we hear various explanations about change in markets. So if markets are running up, there's a story justifying why they are running up. When markets fall, there's a story again to justify why they are falling. To me as an investor, it doesn't change anything. If my horizons are long, I don't need to get influenced by stories, number one. Many times these stories are anecdotes or emotions, about macro stories. And the richest investor in the world says that I don't understand what the next budget is going to do. I don't understand how will interest rates of Federal Reserve move. They themselves don't understand. Who am I to understand? So I would only urge investors not to get too anchored around a lot of these macro stories, but ask some simple questions. Time horizon, my appetite for risk. Am I buying when there's too much of euphoria, or am I buying when there's too much of pessimism, or is it somewhere middle? And accordingly choose your product design. And I think I repeat this again. There's always this debate about what role does an advisor bring. So since we're talking of cricket, you need a good coach. Ask your coach that if this is my attitude to volatility, what are the right products for me?
Okay, that's interesting. And Selva Kumar, I hope it answers your question, because Selva Kumar's question was more about today on the Mutual Fund Show Forum about is today's deep dive because of the US inflation data due today. I think Kalpen's, in a manner of speaking, answer your question. Even if that were the case, and if the data is drastically different from what it was expected to be, it won't change the long-term story in a meaningful way. And stop looking at such short data points.
There is someone who said that your medical bills 20 years from now will only be higher. Your lifestyle expenses 20 years from now will only be higher. So what does Fed do today? What does Reserve Bank do today? What was the budget last year? We don't even remember that. So why do we involve those data points in our decision making? They are futile and not so relevant.
Okay, my last question to you, Kalpen, and that's the other point of the checklist, right? I can understand. Are they making short-term predictions? I can understand that if people get into making too much of short-term predictions, then from a futuristic decision-making perspective, maybe not best to listen to such a commentator. But are they focused on economics rather than valuation? Why do you make this point?
So the reason I make this point is, economics is like literature and art. A lot of variables which we can't control, and the interplay of thousands of variables which are very difficult to decipher at times. We can use them as broad guiding principles, but end of the day, what do we pay for the earnings of corporate India also determines what returns you make. So in the year 2000, if IT as a sector made great storytelling that our IT companies will become very large and so on and so forth. But if they were available at 90 times valuation, if you paid 90 times, even after 15 years, the returns will be lesser than a fixed deposit. So which is why this question is important, that are we overpaying for an asset class? And that dimension also is something we need to discuss more about.
Okay, great. There's a bunch of I have a bunch of questions, and maybe we'll take some of those questions with Nirav Panchmatia as well. I think one question that's come in, if I can get a very quick view before we get Nirav in the show, comes in from Rishikesh Pawar. He's asking, what's the opinion of mutual fund managers' view on cryptocurrency market where the return is 1200% returns rather than holding mutual funds getting 18 to 20% returns?
So
I can give an answer too,
but you can.
No, please.
I have no view and I have no expertise to comment on, so it's unfair. I don't invest in cryptocurrency. I don't understand them, and it's an asset class which a lot of people are talking about. I don't have an expertise to answer that, and hence it's not right to comment.
And which is why I guess my answer would have been that you really need to watch a cryptocurrency show for that, because I don't think anybody who comes on the mutual fund forum would probably be equipped enough to tell you what a Bitcoin or a Ethereum or etc. will do over the course of the next 10, 12 years. So maybe, just maybe, at the risk of losing a viewer, I would urge that you probably need to watch a cryptocurrency based show and hear those experts to try and figure out whether that's the right asset class for you. But Kalpen, thank you so much for taking the time out and joining in, and well, giving us the checklist as well. It was fairly interesting.
Thanks
for being
with
us.
All the best.
All right, so that's Kalpen Parekh with his thoughts. Now, while we talk about funds and what should individual investors do, let's get in Jayesh Khilnani, who comes in and talks about what are the kind of products that have worked the best in the mutual fund industry when there have been volatile times. Jayesh?
So Neeraj, balanced fund is the category that I'm referring to because that has seen a lot of traction in recent times, and as per what the claims have been from the mutual fund, this product is designed to protect you against the fall that we saw in the market. So first, let's have a look at how the fall actually was. So I've done a comparison of the Nifty mid cap and the small cap index from their Jan high to the Feb low. Now if you compare the return, so Nifty fell as much as 8%, mid cap index was down 14%, and the small cap index fell about 20%. This is on an index basis. Now, I did a comparison of the balanced fund category and some of the larger funds, how they performed during this period, and they have actually outperformed the indices. So if you look at ICICI Prudential Balanced Fund, that fell only 4%, and SBI Magnum fell about 5%, and HDFC Balanced Fund fell as much as 4.6%. So definitely some cushion provided to the investors during the recent fall that we have seen.
Okay, Jayesh, interesting. Many thanks for that. Nirav Panchmatia of AUM Financial Advisors with us on the show as well. And Nirav, thanks so much for joining in. Now, Jayesh was just making a point about how balanced funds have held investors in good stead when it's come to dealing with volatile times. The point is that just before we were talking to Kalpen Parekh, and Kalpen was making this point, maybe rightly so as well, that if your time horizon is indeed long term, which would be about 10 years and all, then you don't really need to bother with the short term volatility, and therefore maybe don't need to bother with investing in balanced funds or otherwise. Equity mutual funds will do the trick for you. What are your thoughts?
True. So that's a very tricky question. It's very because if you have a long term view, it doesn't matter.
Okay.
100% sure. The problem is the lay investor, especially if he's not being hand-holded by somebody, generally because of the market volatility gets scared. And even if he is a long-term investor, because of the volatile market, as we have seen volatility in recent time, he tends to get out of it, right? If that be the case, and if he cannot handle the emotional upheavals in the market, it is better that we move that certain asset from his portfolio to funds where you can protect the downside hit that the portfolio can get.
So would balanced fund be that option?
So balanced fund and more, so balance is a passive category. I would rather refer to a category known as an asset allocation fund.
Okay, what does this do?
So an asset allocation fund, as against a balanced fund, has a range in which it can move the equity allocation of the fund. Right. So let me take an example of an ICICI Prudential Dynamic Plan. Theoretically, it can move money into equity between 0 to 100%.
Okay.
Right now, that fund is 67% invested in equity. It can move all the way, guide it all the way to 100% equity. A balanced fund has at max 10-15% gyration range available where it can move between or out of equity. In times like we are living today, 2018, no doubt will be a very volatile year because the liquidity cycle internationally is, because of US bond rates going high, liquidity is getting sucked out of the system. Same is happening in India. Markets are going to be volatile. You need a fund where the fund manager can move more than 20-30% between equity allocation.
If it goes below 66%, then does the tax treatment of the fund change?
Okay, so here's where the ingenuity of the mutual fund companies come into picture. That's the beauty. So the requirement is 65% should be in equity, whether pure equity, naked equity, or you can do a hedging and go into futures and options, or you can also take arbitrage funds. So that fund manager will ensure that no point of time the combination of these three products will be less than 65. So it will always keep on attracting equity taxation, which is the attractive part of this product. At the same time, even though you are enjoying an equity taxation, you can, if you feel the market is very highly valued and very risky, you can move the needle down and you can move all the way less than 50-55% in equity too. But if the market corrects, that guy can move all the way 30-40% up into equity, and that is what a lay investor is supposed to do. But because emotions come in between, as Kalpen was rightly pointing out, behavior comes in between. We tend to sell when others are selling, and we tend to buy when others are buying. So a lay investor, even experts, are not able to do what they are supposed to do.
Okay, so asset allocation fund. Okay, some examples that you've given, and I just want you to tell us what's the mutual fund that you've chosen here versus the BSE 100. The graphics will come up on your screen.
Sure.
But different dates that Nirav has chosen, but in the mutual fund change compared to the BSE 100 change was starkly different.
Sure.
What are you trying to point out?
So we took the example of Aditya Birla Sun Life Balance Advantage Fund. So we went back 3-4 years, right? We took certain dates when the market gyrated a lot, when there were huge corrections. So one was probably February 16, when the market over the last year went down by around 25-26%. And this particular fund went down by only 10%. Again, during demonetization, the benchmark BSE 100 went down a lot. And this fund went down half compared to that particular fund. Again, recently, in the last month, this fund corrected by around 7%. The benchmark corrected by 7%, and Birla Advantage Fund corrected by only 1%. Or in fact, it went up 1%.
Gain 1%.
I don't have data on me right now.
Gain 1%.
So the trick of the trade in 2018-19 in a volatile market is if everything falls, you are going to fall. If everything goes up, you'll go up. The trick of the trade is you fall less when the market falls, less than the market, less than the index. When the market goes up, it's okay if you go up a little bit, less compared to the index. But today, 2018 calls for protect your capital, protect your profits.
And therefore asset allocation.
Yeah, if you survive that, therefore asset allocation, therefore not pure equity fund. If you survive 2018, you will probably thrive in 2019 and 2020. But if you don't survive 2018, where is the question of thriving in 2019?
So is the asset allocation fund different from a balanced fund versus an equity savings fund?
Sure. So then these all the three are technically known as hybrid funds. At the bottom is an equity savings fund where the equity component can move between 0 to let's say 30% at max.
Okay.
Normally it is around 20%, and the remaining is in debt. Okay, this is a advanced version of MIPs that we had earlier. Asset allocation comes in between these two products where the equity can guide it anywhere between, it can go as high as 70-80. So if it is a 70-80 equity, it goes into equity, it is more like a balanced fund. On the lower side, it can become an equity savings fund. And a balanced fund, the range is not more than 10-15%. So a balanced fund which can at max go 80 in equity, and if it is at 70 equity today, has only 10% equity range to play if the market corrects.
Okay.
Whereas an asset allocation fund can move by 30-40%. And if the market corrects a lot in this particular year, it can be the biggest beneficiary post the correction.
Okay, so that's an important distinction. A lot of people tend to get confused as to what's hybrid, what's balanced versus what's equity savings, and that's a definition. I have a couple of questions which I very quickly want to take, Nirav.
Sure.
One is from Sarvanan. He's asking, can you please suggest us an index fund that we can hold for more than 10 years?
Okay.
Any thoughts here?
So all equity funds, all index funds, you should, and if you can hold for more than 10 years, fantastic. Now, the thing is, it is a very generic question. So index fund can be funds that mirror Nifty, that mirror Sensex, or that mirror much more aggressive indices like a mid cap or a small cap. One of my favorite is an index fund which will mirror Nifty free float mid cap 100 index, because that index has outperformed all index over the last 3, 4, 5 years. There is a product from ICCI, there is a product from probably Reliance which mirrors this particular index. That is the index fund I'll suggest to this guy. So there's a iPro IVIN index fund.
iPro IVIN.
Yeah.
Okay.
Nifty free float index fund. He can invest in that fund. Index funds are less expensive compared to other funds. Although the alpha that a fund manager can give you in an active fund, index fund is a passive fund, is much more. If he is going to put money for 10 years, and if he can bear the volatility of 10 years, and if the investment horizon is so huge, why go for an index fund at all?
Okay, fine.
Right.
Okay. There's one more question that's come in actually. And you would know this, maybe
Sure.
I could ask Kalpen about it, but does DSP Microcap Fund allow buying NAVs now?
So I think DSP Kalpen was the best guy.
Yeah.
I think in between DSP Microcap Fund stopped taking further money, rightfully so. And here I should draw a point that some mutual fund companies have stopped taking money in some funds, and we should give thumbs up to all these companies because they find that in this particular market you should not go for microcap, or the AUM of the fund has grown so much that they don't have good investing opportunities. I think it is closed right now. And there is a calibration of all those funds. So in that light, you have to. But this is a good question. Let me give you an observation. The particular investor has chosen DSP Microcap Fund because it is the top performing fund based on the last few years. And let me point out, Neeraj, that in 2018, if you do an Excel sheet analysis and if you choose funds based on highest return in the past year, it is a recipe for disaster.
Okay, so
in fact, if you do the other way around. So this is the year where there are two terms that an investor should learn by heart: asset allocation and risk-adjusted return. Don't go for highest performing return. In fact, if you go for funds with the lowest performing return, you tend to be better off in 2018 and 19. And please choose asset allocation. That is, choose asset allocation funds, or if you have funds in micro cap and small cap, you can move them to large cap or hybrid funds. Okay. And use SIPs very aggressively. Nothing like SIPs, nothing like systematic transfer plans.
Okay, great. Nirav Panchmatia, thanks so much for joining in today as well. And viewers, thanks for tuning in. Afraid we are out of time completely on this show. Thanks so much for joining.